All right. Good afternoon, everyone. I see some folks joining us. And welcome to the afternoon portion of CPA Summit. Glad to have you all here. As more folks join in, we'll give them a moment to join us. But I'm going to introduce our speakers here. My name is Bill Sheridan, by the way. I'm the Chief Communications Officer with the Maryland Association of CPAs. Glad to have you here. Glad to be here. Welcome to Attract New Clients, Grow Your Practice, and Increase Service Offerings, Cost Segregation Studies and Research and Development Tax Credits. And it's my pleasure to introduce our speakers for this afternoon. They are Les Bryson and Ashley Sullivan. Les is a director at MS Consultants, where he oversees the education and awareness and operational capabilities of probity tax recovery. He founded Probity in 2018 to provide tax credit and incentive services to small and mid-sized businesses. Ashley is a director at MSC, where she oversees all operational activities and works closely with practice leaders to drive business development across the country. Les, Ashley, thank you for being here. Thanks for joining us. I'm going to turn it over to you, and I think, Ashley, you're going to lead us off. So welcome.
Thank you, Bill. Good afternoon, everyone. We are excited to be joining you all today. We've got a lot of great information. Before we get started, we kind of transitioned the presentation. So we were in the holiday spirit. We've got kind of a 2-for-1 holiday offering here. For those of you in the public sector, we kind of sprinkled in a little bit of an opportunity to kind of understand the partnering aspect and creating somewhat of another service line for your existing clientele, in addition to the educational component of the overview and update that we'll do on cost segs and the R&D tax credits. And then for those of you who are in the private sector, where creating a specialized niche kind of book of business isn't really something that's going to pertain to you, that's going to be the very beginning part of the presentation. It will go quick, and then we'll kind of take a deep dive into the educational component of these two areas. This is somewhat of just a statement saying that these are opinions of myself and Les, and they are based on tax law today. We do work with a variety of clients and accounting firms in the Maryland area. So for those of you who know us, it's glad to be with you today. And for those of you who maybe don't know who we are, just a little bit of an introduction. MS Consultants, also known as MSC, and then we have Probity Tax Recovery. These two firms merged, I believe it went into effect at the beginning of November this year. A little background on MSC. We've been around since 1996. Our bread and butter is cost segregation. However, with expansion of tax laws, we have kind of moved away from just focusing on cost seg and really becoming fixed asset experts, whether it's back of the house for our accounting firms or for our end users, just kind of bringing to the table a variety of opportunities to generate some additional tax savings. And like Bill had mentioned in regards to Probity, Les had started that firm in 2018. Both Les and I both are technical. Neither one of us are, even though we do sales in our position, we both have the technical background. So feel free to include your questions in the chat, and we will do our best to get to them. Our agenda today, as I had mentioned earlier, we're just going to talk a little bit about kind of building that back of the house specialized niche relationship with firms that can provide the types of services regarding deductions and tax credits, other incentives to generate that additional cash flow and or create some tax savings. And then we'll take a little bit of a deep dive into cost segregation, where we are today, maybe what we're expecting around the corner, and or unique situations that we're experiencing in that realm. And then Les will close it out with taking a deep dive on the research and development tax credit. So in regards to outsourcing, I was talking to Les earlier. I think we have 5 slides here. The key thing that I want you to take away is when you're looking at these certain types of tax saving opportunities, they are very specialized. They take a little bit of a different type of expertise. And so in our experiencing, what we're noticing is we partner with over 300 accounting firms, and we're really your back of the house experts when it comes to fixed assets. And, you know, I think every day it's taking phone calls, and there's certain things that are coming across our clients' desks, and we're just collaborating. And, you know, for both of us, the best interest is your clients. So we want to make sure that we are making sure that any opportunity that's available to generate those tax savings, that we're addressing to them, and that you feel confident that you have experts in your back pocket to be able to provide this specialized, provide these specialized services to your clients. There's a variety of different ways that you can partner with firms to be able to provide these specialized services. I would say if you want to generate a different level of revenue stream, there's white labeling services that can occur to where you customize our reports to show as yours, and we really represent your firm as your firm. So your clients believe that it's somewhat of an additional tool that you all are offering to your clients, that it's coming from the firm that they've built and they've created that trust with. And then there's other aspects of creating somewhat of a referral-based relationship, where whatever may work best for you to be able to either create an introduction and kind of transition that off, or working hand in hand together with your clients. So some of the benefits of creating this outsourcing relationship, you're maximizing internal resources rather than having to hire additional employees with different areas of expertise. You're relying on an existing company that has created and has years of that expertise that can provide that quality work that they stand behind. It also allows you to optimize time. Employees that may not be overly qualified in the relevant area of work, there's additional research that may be needed. And so what we tend to experience, again, like if someone's reviewing an invoice as to whether something has to be capitalized or if it can be an expense, if a new roof is going on the building, it's just a quick call and reach out, and you have assigned account managers who kind of work the relationship with you and go through the process as to, you know, what opportunities there are to consider for that. Again, with another few benefits, the expertise and experience. We've got, I think, a combined, I think we're almost at 300 years of experience with bringing on our probity folks to the team. So we've got thousands and thousands of studies that we've completed. We have audit experience. You know, we're engulfed within the industries that deal with this on a daily basis. We know what folks are experiencing. We know what the IRS is looking at. And, you know, we stand behind the work that's completed. And then it also allows for relying on the relationship component to kind of invest in that technology that's needed to complete these types of studies. rather than your firm having to invest in that. So again, just make sure if you're considering adding this additional service line to your book of business, that you're partnering with a firm that has credibility, that has experience within the industry, that backs up their work. We have seen a little bit of an uptick in audits, at least on the cost segregation side. We've seen a lot of exceptions that were made during the COVID timeframe that just aren't being accepted any longer. However, there are firms out there that, for example, aren't doing site visits. And I've seen the IRS kind of toss out work immediately if a qualified individual isn't completing a site visit. So just make sure you take your time to partner with the correct firm. It's all relationship based. The same way you build trust with your client, you want to make sure that you're building that trust with whomever you're partnering with. So as we move in to cost segregation, just kind of a brief overview for those who may not be familiar. It is an IRS approved methodology to accelerate depreciation. And so ultimately, when you accelerate depreciation, you are creating larger deductions in the earlier years of this property, which reduces taxable income and increases cash flow because they're paying less taxes. In the most simplistic form, I say it's rebuilding a building for tax depreciation purposes. It's pertaining to IRS tax code section 1245 and section 1250 property. And in the process of rebuilding those buildings or parts thereof, you are quantifying and allocating costs between what's personal property, section 1245 property. On the federal side, when you get into state kind of personal property tax purposes, there are different definitions. But looking at cost seg from a federal component, you've got the personal property for section 1245, and then you have your real property, section 1250, which is more of your building, structural, and land improvements. And we'll go through an example. I apologize if this is small, even me looking at it, it's a little bit small, but this basically just shows depreciation by year with no bonus depreciation. So with the cost segregation study, when you're shifting costs from those long lives, the 39-year for commercial or 27.5-year for residential, and you're shifting them to 15, 7, or 5, depending on the year, you are potentially opening up bonus depreciation. And this just kind of gives you a broad, big picture overview of if you had $1 million and it was depreciating over the life of the property, these are typically what your depreciation deductions would look like. So when we get into the examples next, you'll see the differences that occur. So for this example, we're dealing with a $7.5 million depreciable basis. So client acquired a property for more than 7.5 million. We backed out the land value, which is non-depreciable. And we are going to show, this is actually the office we sit in the Virginia Beach area. We're going to show you an example here where we've got a $7.5 million property. Now, most folks ask me, okay, well, we don't have a $7.5 million property. Well, in today's time frame, you don't need a $7.5 million property to benefit from a cost seg study. Bonus depreciation comes into play a little bit as far as what basis is generally needed to start with to make the study worthwhile. And it depends on the type of property. So if it's an improvement property and we're opening up qualified improvement property opportunities, we can deal with a basis as low as $300,000, $400,000. If we're looking at an acquisition, maybe current year where bonus depreciation is phasing down, you're looking at about that $1 million basis price range. But there's no cost to reach out and ask questions. Complimentary preliminary analysis based on a few pieces of information. But for this example, we're dealing with $7.5 million depreciable basis for an acquisition of that office building. Without the cost seg study, they purchased that building for a lump sum, so they have no idea what the costs are of the components within the building or the building itself. So we're depreciating that over 39 years. This happened to be a 2017 acquisition, and they're doing the cost seg study in 2024. No amending required. So from 2017 through 2023 year end, with $7.5 million being depreciated over 39 years, they recognized a little over 1.2 million in depreciation deductions. As a result of having the cost seg study completed, we were able to shift about 24% to a shorter depreciable life, which resulted in depreciation of a little over 2.1 million. So what the IRS allows us to do in 2024 is we catch up all that missed depreciation in the current tax year. So the taxpayer was able to recognize over $950,000 of missed depreciation. So 2017 acquisition, we had a big change in the tax law, Tax Cuts and Jobs Act. This is not showing bonus depreciation, so it must have been before that September 27th, 2017 date, the acquisition, which was when bonus depreciation transitioned to used property. So our next example kind of shifts you to, okay, now we've got a new construction here, which new construction in 2017, whether it was pre or post 927, we would have had bonus depreciation. But instead of I'm just going to shift back, instead of the 383,000 in depreciation or deferred tax savings, now we're recognizing over 470,000 in deferred tax savings, with it being new construction and having that bonus depreciation opportunity. So when you look at the acquisition to new construction, again, it's the catch up through a Form 3115, no amending. With the new construction, it opened up the bonus opportunity for what was 50% bonus. And then eventually we had that transition to 100%. Now looking at the current year for 2024, same property, same $7.5 million basis. So 2024 acquisition or construction, so it can be used or new property. 2024, we are with 60% bonus depreciation. Based on current law, there are several talks of that being changed. We are not sure on timing as of yet. But what you're seeing with cost segs in 2024, when you have 60%, so everything that gets reallocated to the 15, 7, or 5 year, you recognize 60% of that in the current tax year. So you're starting to see that shift. When we had 100%, 80% bonus depreciation, most of it was recognized in a very large deduction in year one. Now with 60%, because you have that 40% differential, you're seeing that shift occur to where it's spread over the first 5 years of the property in comparison to just that first year. So what we're seeing in the cost seg industry is if, again, basis is playing a role. So when we were at 100% bonus depreciation, we were dealing with much smaller basis numbers. That's changing slightly. And also just educating our taxpayers that instead of a first year very large tax deduction, we're just starting to see that spread over the 5 years. So hold periods could come into an effect here as to whether or not it's worthwhile. But we still have bonus depreciation next year if no changes. Again, we're hearing if changes occur, it could be 25, could be 26, could be retroactive. But this year we're at 60%. In 2025, we will potentially be at 40% if no changes. Some of the items, even with the cost seg, so at the end of the day, when cost seg is a time value of money, it's better to have $1 today than $1 in 39 years. That increased cash flow as a result of the larger deductions. The ultimate goal is either you're putting that back into your property, maybe increasing rents, attracting in new clients, or moving on to your next investment property. Even with the cost seg, you're always going to end up with your building. So for that building to function as a building, or if you're looking at improvement projects, you're separating out structural components versus what's land improvements versus what's considered personal property for Section 1245 purposes. So here are just some examples of what tends to be left at the longer life: your HVAC, your primary HVAC system, your roofs, ceramic tile, exterior doors and windows, concrete slabs, framing, drywall, certain ceiling tiles, exterior facade. Kind of for anything for that building to be enclosed as a building and function as a building is going to be your structural components. Your land improvements, landscaping, trees, irrigation, sidewalks, retaining walls. If you have storm systems, like at a retention pond, you can take the electrical servicing the fountains and the ponds. You have certain components of street lighting going into your pavements, your striping on your pavement, certain like handicap symbols on your pavement. Certain utilities are 15-year. And then getting into your 1245 property, I think these are examples. Well, it looks like one's a hotel, one's maybe, oh, I think these are all hotels. But window treatments, decorative trim like your baseboards, crown molding, chair railings, certain special electrical and plumbing, carpet, other removable flooring, luxury vinyl tile, luxury vinyl plank, certain decorative lighting, certain built-in cabinetry can all be considered that Section 1245 property. When you get into specific kind of manufacturing, you can imagine that there's substantial electrical supporting what's going on in the building. You have some growing facilities depending on what's occurring again in those particular properties. I believe I do have a slide in here that kind of showcases on the use of the property, what's the average reallocation of assets of having a cost-seg study. So a restaurant, a manufacturing facility, when it's heavy electrical and plumbing, is going to increase those benefits from a cost-seg study. Who can benefit? New buildings under construction, existing buildings undergoing renovations, acquisitions of existing properties. We can go as far back as 1987, but believe me, I know that it doesn't really make sense to go that far back, but someone who's held a building for that long, generally they're going to be improving it. And then with the tangible property regulations, there's still some opportunities to clean up depreciation schedules. So if you have anything with long life assets sitting on the books, it'd just be something that you maybe want to consider to see if there's an opportunity there. Also, inherited buildings, when step-ups are occurring, you can have cost-seg studies on that step-up as well. This was the slide I was referring to. On the heavier side, it looks like restaurants, manufacturing facilities, but even shifting, 12% to shorter depreciable lives with that bonus depreciation, it's going to generate some substantial savings for your clients. So things to keep in mind when you're considering cost segregation studies for your properties or your clients. Are they profitable? Can they generate the loss? Do they need the deductions? Are they only going to be holding the property? So with the cost seg, because it's time value of money, generally you need a little bit of time to generate that return for you. So if you're only going to be holding it for a year or two, it may not make sense. Passive loss limitations, how much of the deductions can they actually use? Also to keep in mind with that, the single economic unit election, a lot of the dentist doctors that we work with, if they are acquiring or building their own buildings, they can potentially take the losses from the real estate side with that single economic unit election to offset the operations income. Estate planning purposes for those step ups. You've got to remember intent to demolish. There is some GAA rules you can consider with real estate. If a taxpayer is acquiring a building, going to be tearing it down, Within the next couple years, you may want to consider the GAA election. That way it doesn't have to go all to land in the future and they can continue depreciating. There are some limitations there. There's great opportunities with 1031 exchanges still, with cost segs, the 80-20 rule, mixed use properties. If more than 80% of the revenue is generated by the residential rental units, you've got a residential property. You kind of lose out on that qualified improvement property when improvements are occurring. If it's less than 80%, then it turns into a commercial property and you kind of open up some other opportunities there. We're also seeing a lot of short-term rental properties, kind of single family home where people are having cost seg studies completed. And just remember, you've got some different rules there to where maybe a short-term single family home rental property is not residential. It's not a 27.5-year asset because the stays are generally 7 days or less. And it's kind of looked at as similar to a hotel and it converts to that commercial property. So just a few things to consider as you're working with your clients who own real estate. So again, the benefits of cost seg increase the depreciation in the earlier years. You're paying less taxes with those larger deductions. There is some permanent savings when buildings are sold. And then as a result of tangible property regs for the first time, I think that started back in 2014, you can write off structural components now when they're being replaced. And with the cost seg, you'll have the breakdown of your building and a report with all of the costs associated with it. That provides you the opportunity to be able to write off the remaining basis of those assets when they're replaced. No amended returns needed. You've got the Form 3115 opportunities. Everything that's recognized when the study is completed and the tax year it's going to be incorporated into, it's all recognized in that 1 year. And then as a result of reallocating assets, you're opening up those bonus opportunities. So lots of opportunities to consider. Depending on what happens with bonus depreciation, could change a few things. If we go back to 100% bonus depreciation, you see that basis drop down in regards to requirements. But just remember, there's no cost to reach out, ask questions. We'll tell you no if it's not going to be worthwhile and explain as to why. But I am going to stop sharing so Les can jump in because he's going to take it over and talk about the R&D tax credits. And Bill, I don't know if any questions came in.
Yeah, so far I have not seen any. So thank you, Ashley. I'm going to turn it over to Les. Just a quick reminder to folks who are listening in, if you do have questions, feel free to post them in the chat and we'll get to as many of them as we can toward the end of the session. But Les, we'll turn it over to you.
Thank you, Bill, and thank you, Ashley. And yeah, we'll change gears here. We'll start talking about the research and development tax credit, and all as much of the ins and outs as we can cover in our time frame here. So, first, our overview here is we're going to talk about some foundational concepts, things that some of you, maybe most of you, already know, but for those of you who are not as familiar on the compliance side, I'm going to cover some foundation, talk about the background of the R&D tax credit, talk about some of the more important changes that have occurred with the R&D tax credit, and then I'm going to touch on, of course, that Section 174 change, how everybody now has to amortize research spending instead of being able to deduct it in the year that it was incurred. So, I'd like to start off talking about, especially when dealing with credits versus deductions, a quick review of tax and taxable income and how we have C corps and pass-throughs and those concepts. So let's dive into that just real quick. So taxable income is the income net of the costs and deductions for the business. It's the amount of income that winds up being taxed. So you take the taxable income, you multiply that by the tax rate, and then that is the amount of tax that you're going to pay. That's what you owe the government. And so, yeah, we have to calculate taxable income in order to determine what the actual tax is going to be. Now, when we talk about taxable income, it's important to note the difference between corporations that are taxed themselves versus pass-through entities where the income flows through to an individual or other entity before it is taxed. So for a corporation, we have gross receipts or revenue. We reduce cost of goods sold to determine the total income or loss if this value is negative. And then we have the items that we can deduct. Those total deductions then are reduce the total income to find the taxable income, and that is the amount that winds up being taxed. So there's an example, and I contrast this with a pass-through entity, an S corp or a partnership, where your calculation on the left side here of the table for a C corporation, going back one slide, the taxable income is what we're calculating. For a pass-through entity, we're actually calculating the ordinary business income. And if it's flowing through to an individual, that ordinary business income is combined with other sources of income for the individual to get the adjusted gross income. And then the deductions are used to get to the taxable income. And so that's the difference here. Again, we're talking about two different types of taxpayers, corporate taxpayers versus individual taxpayers. The reason why this is important for our purposes here is because like certain items of income, deduction, etc., the R&D tax credit passes through to the shareholders or partners of an S corp or partnership. So one last note, I've had conversations where this concept was confused a lot, so I like to hit this pretty hard. With the R&D tax credit, we're talking about a tax credit that is a dollar for dollar reduction of a taxpayer's tax due. The R&D tax credit is not a deduction. It's its own section in the code with all the different tax credits. There's a separate section that, again, we'll talk about later that deals with what deductions you can get from R&D activities, R&D spending on R&D activities. So again, there's a stark difference between a credit versus a deduction. The way to drive this home is in this table here. If you had a $100,000 deduction versus a $100,000 credit, again, if it's a deduction, if your income is $1 million, the deduction reduces your taxable income by the $100,000. At a 21% tax rate, that yields a $189,000 tax bill. If instead you said, hey, I don't want $100,000 of deduction, I want $100,000 of credit, then you have the far right-hand column here. The $1 million is taxable. It's taxed at 21%, the same $210,000 tax bill. The credit hits here on the actual amount of tax owed. So again, a dollar of credit is more powerful tax savings wise than a dollar of deduction. Again, these are all just review of certain concepts, but if you have any questions, of course, let us know. Now, diving into the actual history of the R&D tax credit, I'm going to go through this quickly. So the R&D tax credit's been around since the early 80s. It came to be because the U.S., was in a recession during the late 70s and early 80s. And so Congress and the then administration, the Reagan administration, said, hey, we need to pull the country out of this recession. So they passed a bill that included, among a bunch of other things, the R&D tax credit. And its intent, of course, was to get companies to continue or to focus more on spending on developing new technologies, employing people that were developing those technologies, improving systems, products, etc. The credit was and still is a federal tax incentive that provides a cash benefit, so cash direct tax savings to companies conducting R&D in the U.S. It's claimed on an entity's federal tax return. It's used to primarily offset income taxes. There's a caveat there that we'll go into. And again, it is not a deduction. We will deal with the interplay between the deductions and credits, but for now, again, it is a federal tax credit that allows businesses to reduce their taxes for conducting qualified R&D activities. The code section for the R&D tax credit is section 41, the credit for increasing research activities. That's the title. It is an incremental credit. meaning that it's calculated based on an evaluation of prior activities. Specifically, you look at the tax year in question and you compare your spending to some prior time period, depending upon certain elections that are being made. It was initially enacted as part of the Economic Recovery Tax Act in 1981, or the ERTA. It was temporarily extended 16 times before finally becoming permanent after the PATH Act was enacted at the end of 2015. Just a brief history lesson. So the important thing here is that it's called, as I mentioned, the Credit for Increasing Research Activities. But that's a bit of a misnomer. It's more of a credit that incentivizes predominantly employing people that are technical. So important notes here conceptually is a business does not have to be conducting laboratory R&D to qualify. The rules are such that there's a four-part test that some of you may be familiar with. As long as you are conducting activities that meet the qualifications of that four-part test, then that's what is required. A laboratory is not one of them. It can qualify if it is laboratory R&D, but that is not required. A business does not have to have degreed scientists or engineers on staff to qualify. Again, that is not one of the four parts of the four-part test. A business does not have to be inventing new or improved technologies to qualify. It doesn't have to be something that is patentable or patented. Again, those activities certainly will likely qualify, but it's not a requirement. That's not one of the tests. And again, the increasing research activities part, that's not necessarily true because of how the credit has changed over time. A business can have less R&D activity, fewer R&D dollars spent in a given tax year, and still be able to calculate and claim a credit. It wouldn't be as high as usual, but it is still possible because of the mechanics of the actual calculation. So the PATH Act, as mentioned, it made the R&D tax credit permanent. It also specified that qualified small businesses can use the R&D tax credit to offset future payroll taxes. As I mentioned a few slides ago, the R&D tax credit is predominantly used to offset income taxes. Here's the caveat. If a qualified small business or a startup company makes the right election and has the right parameters, the right boxes checked, so to speak, then they can use that credit to offset payroll taxes. And we'll talk a little bit more about that in the future. So with changes, Tax Cuts in Jobs Act, the Tax Cuts in Jobs Act was enacted in 2017. It did not directly change Section 41, but it did modify two sections that are referenced and impact Section 41. Specifically, it modified Section 174, which is that it used to be that you could deduct your R&D expenditures in the year that they were incurred. That was modified in order to pay for some of the tax cuts that the Tax Cuts and Jobs Act enacted. And accordingly, it updated Section 280C. Section 280C is the reduced credit election that some of you may be familiar with. It basically stated that because your R&D credit is being calculated based off of expenditures that you are deducting elsewhere on the return, you cannot double dip. So you had to reduce the amount of your deductions by the amount of the credit. For example, if you had $1 million in deductions for all R&D spending and you had a $100,000 credit that you calculated from that, you can no longer deduct the entire million. You had to reduce the million by the $100,000 credit. So now your deductions go from $1 million to $900,000. Because of the change to Section 174, now you're not getting the entirety of the deduction for the R&D spending. So they modified 280C to state that you don't have to do that add back. You don't have to do that reduction of deductions if the R&D credit is less than or equal to the amount of your 174 amortization deduction. That's a lot. Again, if you have questions about it, if we don't answer them throughout this presentation, then let's talk at the end. The more recent main sort of tax bill that occurred, which again, depending upon what happens after the inauguration. Most of this might be unwound in short order, but the Inflation Reduction Act increased so that ability for startup companies, for qualified small businesses to offset payroll taxes. There was a limit of $250,000 per tax year. So if you calculated a credit in excess of $250,000, you could only earmark that $250,000 to go to payroll taxes. The rest stayed as an income tax credit. The Inflation Reduction Act increased that amount. It doubled it to $500,000 per year, with some limitations, of course. So that was really the only thing that happened with the Inflation Reduction Act as it relates to the R&D tax credit. So let's talk about the change to 174. This was a big deal. Code Section 174, Internal Revenue Code Section 174, was initially enacted in 1954. It was titled Research and Experimental Expenditures. It specifically dealt with the tax treatment of research spending. The default treatment, so if no elections were made, then you immediately deduct those expenditures in the year that they were incurred, and you could make an election to amortize those costs for whatever reason. You want to do that. If you wanted to break that up and delay it over a longer time frame, you can make an election to do that. Most of the people that I've worked with were obviously deducting their R&D costs, and we calculate credits for them, etc. This change from the 2017 Tax Cuts and Jobs Act, it has directly impacted everybody that we work with, and I'll talk about how. So the Tax Cuts and Jobs Act was designed to lower taxes predominantly for businesses. In order to pay for those tax cuts, other aspects of the tax code had to change. It's the whole the concept of congressional scoring. If you lower tax rates, well, in order to make sure that all the tax revenue to the country is not completely gone or it's drastically reduced, they change other aspects of the tax code with that same bill to increase tax revenues elsewhere so that it makes up for the loss of tax revenues. And that scoring is done all the time when we're talking about changes to tax law. So the change to 174, it changed it from just immediately expensing R&D spending to amortizing. So what does that mean? This is the original text, 174A and 174B. Again, the default was that treatment as expenses, and B was an election to amortize. Well, the Tax Cuts and Jobs Act said that starting in tax year 2022, you can only amortize your R&D spending. So that 174A is now gone, no longer exists. You're only amortizing those costs. What else did it do? It also defined R&D as anything within the realm of software development. I'm paraphrasing that, but basically, because it was enacted back in 1954, software wasn't really a thing, and so while the R&D tax credit does speak to software development, 174 specifically did not. And so to make sure that it was absolutely clear going forward, effective 2022 and beyond, any kind of software development activity is R&D, and therefore all costs associated with those activities are required to be amortized. Why didn't this matter until now? I've touched on this briefly, but because of Internal Revenue Code Section 162 that says that a business can deduct any ordinary necessary expenditures paid or incurred in carrying on a trade or business, the expenditures that we earmark, if you will, or that we classify as research spending when we're looking at the R&D tax credit, those are wages, those are outside contractor costs, they're material costs that go into things like prototyping, and there are costs associated with software development if you're doing that activity in the cloud. Those four buckets of costs were already being deducted pursuant to Section 162 for pretty much every taxpayer. Because of Section 162, you didn't have to specify when you could deduct all R&D spending. So pre-2022, you didn't have to specify whether or not your deduction was for 162 or 174. It didn't matter. The resulting tax calculation was the same. Starting in 2022, if you have activities defined and expenditures defined under 174, you don't have a choice. You have to be amortizing those costs. So because of 162 in the past, we didn't have to specify. Effective 2022 and beyond, we do. In terms of adding value, we'll talk about the R&D tax credit again here. I mentioned the 4 buckets: wages, supplies, cloud computing costs for the software development and outside contractors. Those first 3 are the in-house expenditures. The final one is external costs. The R&D tax credit is typically, not always, typically going to fall somewhere between 7 and 10% of the total of those 4 buckets. That's going to be the credit. When we talk about the utilization of the credit, there's 3 different groups that we speak about. Profitable businesses are those that are established companies, lots of revenue, lots of income, and they are using the R&D tax credit to offset the company's income tax. Qualified small businesses in the middle row there, those are the startup companies. Those are the ones that can use the R&D tax credit to offset the payroll taxes that they're going to pay. The qualifier there is they have gross receipts less than 5 million, and they did not have gross receipts prior to in this year 2020. So for tax year 2024, you look back in a 5-year window, and the first dollar of gross receipt or the first year that you claim the credit starts the 5-year window, and there's some caveats and such there, but that's the rule for, again, the qualified small businesses, or you can say startup companies. The third type of company, again, if because of the tax cuts in Jobs Act, the eligible small business category used to be for C corps and pass-throughs. Again, Tax Cuts and Jobs Act, it eliminated AMT for C corporations. It came back for larger C corporations with the Inflation Reduction Act. Again, don't know if that's going to stick, but regardless. So we're looking at eligible small businesses can offset AMT, the alternative minimum tax. So if a pass-through entity has less than $50 million in gross receipts, actually average over the prior 3 years, we look at the average of those prior 3 years. If it's less than 50, then, and if they're not publicly traded, then those business owners, when the credit passes through to them, if they are in an AMT position, we can actually bring their tax down to the 25-25 rule. 25% of the tax that exceeds $25,000 is their new sort of minimum threshold. So that's the rule there. So for qualification, and I believe I need to kind of speed up here, Bill, is that the case? Thumbs up, thumbs down?
Yeah, we got
Okay.
about a couple of minutes left. So yeah.
All right, perfect. So for qualification purposes, the 4-part test, we're talking about some examples as well. The 4-part test is if you're developing a new or improved business component, that's something that you that's something that you are doing to further your business, be it a product, process, formula, invention, software, or technique, for the permitted purposes of functionality, reliability, quality, or performance, then you're meeting the first test. Again, it doesn't have to be new to the world. It just needs to be new to you, the taxpayer, or an improvement. You have to have some technical uncertainty that you are eliminating in your activities. The activity or the uncertainty is with respect to capability, methodology, or final design. To overcome the uncertainties, you have to undertake a process of experimentation. Again, it doesn't have to be laboratory, it doesn't have to be done by a scientist. We're talking about a systematic evaluation of alternatives, scientific method or trial and error, modeling, simulation, etc. Again, does not have to happen in a lab. It just needs to be a systematic way of overcoming the uncertainties inherent to the project. And the process of experimentation has to be technological in nature, meaning it has to be based on hard sciences, which are chemistry, biology, computer science, engineering, physics. So again, this can be a number of different things. It doesn't have to be a pharmaceutical company. It doesn't have to be Google. It doesn't have to be Apple. Small to mid-sized businesses can take advantage of this because these rules are very broadly defined. They very broadly define what qualifies R&D. Our target companies are typically going to be architects and engineers with at least $1 million in revenue, certain construction companies, contractors, systems integrators with a lot of employees, software and technology companies. Of course, software is obviously R&D, biotech, pharma, same thing. And then manufacturers. Typically, we see that if a manufacturer has at least $10 million in revenue, then they're a great candidate. We can save them a significant amount of money. This is not the be all end all though. These are the sort of the low hanging fruit. I'll tell you, if anybody is doing something to be more competitive or to stay competitive in their industry, they're likely doing something that meets that 4-part test. And at that point, it's just a question of whether or not the juice is worth the squeeze. As Ashley mentioned, for MS consultants, probity tax recovery works the same way. The upfront evaluation, the assessment as to what we think we can do to save a company money, that's all at no cost, no obligation whatsoever. We just want to see, does it make sense to look at this or not? So I have a few case studies here. Actually, I'm gonna okay. For time here, we can go through the examples if anybody needs to, but for now, actually, I'm going to kick it back to you for the remaining slides here, and then we can answer questions.
I think there's just things last. I think there's just this slide and then our contact information. We've got a lot of great resource guides that provide opportunities for the bonus depreciation structure, definitions, and requirements for all the qualified property, as well as things to consider for working with real estate clients. So please feel free to use the QR code. It just sends us a message and we can get these resource guides to you. I think the other slide is basically it's got both Les's and I's contact information. Don't hesitate to reach out to either of us. Again, we're here to help you service your clients. So no question is a stupid question. We do get some interesting questions that come through. But, you know, right now you're probably finishing up some tax planning or having those discussions. If anything is standing out to you based on something that we've discussed, feel free to give us a call.
I'm going to go back to the QR code for anybody that still needs it. So while we're answering questions, feel free to scan this and you can request the information. And if you, I guess in a couple minutes, I'll go back over to the contact information. So, Bill, were there any questions that came up that we can answer?
You know, you guys must have done just such a great job of explaining everything that you were going through. There are no questions in the chat. So with that, I will remind folks, if you need access to some of the slides, we have a link in the chat where you can download the slides to take with you. They're also available in your My Learning page on the MACPA site, so you can access them there. And please reach out to either Les or Ashley for more questions. You see their contact information there. And with that, we have a few minutes to allow folks to get over to the next session. So Les, Ashley, thank you so much for your time, for your insights. Great session, and we appreciate you being here. Thank you so much.
Thank you, Bill.